The global economy is built on a lie. In 1971, the global financial system changed in a single decision, and most people did not even realize it happened. Since that moment, every dollar, every paycheck, every savings account balance has been backed by nothing physical at all, just confidence and policy. The global economy runs on numbers typed into screens, promises written on paper, and debt that multiplies faster than productivity. Yet almost nobody questions it because the system feels stable enough on the surface. This video breaks down the uncomfortable idea that the global economy may be built on a carefully maintained illusion. And once that illusion is understood, the way money, inflation, and central banks operate starts to look very different. The money illusion. Currency is not what you think. Most people grow up believing money is a store of value, something solid, something earned and saved. But modern currency is not backed by gold, silver, or any tangible commodity. It is backed by trust in governments and institutions. When the United States ended the gold standard in 1971, the dollar became pure fiat, meaning its value is declared rather than anchored. The same structure now applies to most global currencies. The numbers in bank accounts are not physical reserves waiting somewhere in vaults. They are digital entries representing claims within a banking system that constantly expands and contracts. The illusion works because transactions feel real. Salaries arrive, bills get paid, loans get approved. So daily life continues smoothly enough that few stop to question what actually gives money its value. The reality is that value depends on collective belief. If enough people accept currency in exchange for goods and services, it functions. But this belief system is fragile. History has shown multiple examples of currencies losing credibility rapidly when trust erodes, from hyperinflation episodes to sudden devaluations. The system depends on stability, not intrinsic backing. Another layer of the illusion is purchasing power. A dollar today does not buy what it did 20 years ago, yet many still treat money as a fixed measurement. In reality, currency is a fluctuating unit shaped by monetary policy, credit expansion, and economic cycles. Inflation gradually reduces what savings can purchase, which means holding currency is not the same as holding stable value. The number in an account might remain constant while its real-world power declines. That subtle erosion is rarely dramatic enough to cause panic, but over decades it becomes significant. Digital banking has intensified this abstraction. Money now moves at the speed of code. Central banks and financial institutions can create liquidity electronically without printing physical bills. This does not mean unlimited wealth is created. It means new claims on existing goods and services are introduced into the system. The more claims exist relative to production, the more prices adjust. Yet, because the process is technical and distant from everyday life, most people do not see it happening. They only notice rising costs. Understanding the money illusion changes perspective. Currency is not wealth itself. It is a representation, a tool, a medium of exchange that depends on confidence and management. When confidence is high, the system appears strong. When confidence weakens, cracks show quickly. The global economy functions because belief holds it together, not because money is anchored to something permanent. Debt creates money, not value. A surprising truth about modern banking is that most money enters circulation through debt. When commercial banks issue loans, they do not lend out pre-existing deposits in a simple one-to-one way. They create new money in the form of credit. That loan becomes a deposit in someone's account, expanding the total money supply. In other words, money is born from borrowing. This means economic expansion is tightly linked to rising levels of debt across households, our corporations, and governments. This structure encourages growth through leverage. Businesses borrow to expand operations, consumers borrow to purchase homes and cars, governments borrow to fund programs and infrastructure. On the surface, this stimulates economic activity. However, the system requires continuous repayment with interest. That interest was not originally created with the principal, which means more borrowing is often needed to service existing debt. The cycle sustains itself through expansion, but it also increases systemic vulnerability. The distinction between money creation and value creation is critical. Real value comes from productivity, innovation, labor, and resources. Debt-based money can amplify growth when it finances productive investment. But it can also inflate asset bubbles when it flows into speculation rather than tangible output. Housing markets, stock markets, and other financial assets often rise dramatically during periods of aggressive credit expansion. When debt grows faster than underlying productivity, imbalances form. Crises tend to emerge when borrowers can no longer service obligations. At that point, defaults rise, credit tightens, and the money supply can contract as loans are written off. Because so much money originated as debt, repayment or default effectively destroys it. This contraction can trigger recessions. Central banks frequently respond by lowering interest rates or injecting liquidity to stabilize the system, restarting the borrowing cycle. The economy becomes dependent on continual credit growth to maintain momentum. This does not mean debt is inherently negative. Used strategically, it enables progress and development. But understanding that most money is created through borrowing reveals a structural dependency. The global economy is not simply built on trade and productivity. It is built on expanding credit. When credit slows, growth slows. When credit accelerates too quickly, instability builds. The balance is delicate and constantly managed. Why inflation is not an accident? Inflation is often described as a natural byproduct of economic growth, but it is also a policy outcome. Central banks typically aim for a target inflation rate, often around 2% annually. The reasoning is that mild inflation encourages spending and investment rather than hoarding cash. If people expect prices to rise slightly over time, they are more likely to deploy capital productively. From a policy standpoint, controlled inflation is considered a feature, not a flaw. However, sustained inflation has consequences. Over long periods, even modest annual increases compound significantly. What costs 100 units today could cost much more in a few decades. Wages may rise, but not always at the same pace as living expenses. This dynamic gradually shifts purchasing power. Savers holding cash experience erosion, while borrowers benefit because they repaid debts with currency that is worth less than when they borrowed it. This creates subtle redistribution effects within the economy. Inflation also plays a role in managing government debt. When governments carry large debt burdens, moderate inflation reduces the real value of those obligations over time. It effectively lightens the debt load without explicit default. While this can stabilize fiscal systems, it can also distort long-term planning for households. Retirement savings, fixed incomes, and long-term contracts are all sensitive to inflation trends. The complexity increases during periods of high inflation. Supply shocks, energy disruptions, or excessive monetary expansion can accelerate price growth beyond targets. Central banks then tighten policy, raising interest rates to slow borrowing and spending. This can stabilize prices but may also slow economic growth. The balance between stimulating growth and controlling inflation is one of the most challenging aspects of economic management. Recognizing that inflation is influenced by deliberate policy decisions reframes the narrative. It is not simply an unpredictable force of nature. It is tied to how money is created, how credit expands, and how central banks pursue stability. Understanding this relationship helps explain why prices rarely move in one direction permanently and why economic cycles are recurring rather than random. The central banking power structure. Behind every major currency stands a central bank that operates with extraordinary influence over the entire economy. Institutions like the Federal Reserve, the European Central Bank, and others do not simply adjust interest rates in the background. They shape borrowing costs, liquidity levels, asset prices, and even market psychology. A single announcement can move trillions in global markets within minutes. That level of influence is rarely visible in everyday life. Yet it quietly affects mortgage payments, business expansion, job creation, and the value of retirement portfolios. The structure is designed to be independent from short-term political pressure, but that independence also concentrates immense power in unelected financial authorities. Central banks control the price of money itself through interest rates. When rates are low, borrowing becomes attractive, investment accelerates, and asset markets often surge. When rates rise, credit tightens, spending slows, and valuations adjust. These decisions ripple through every layer of society. Corporations restructure, governments adjust budgets, and households feel the difference in loan payments. The system is interconnected to such a degree that even small policy shifts can create global consequences. Financial markets now anticipate central bank signals almost obsessively because expectations alone can drive economic behavior before any official action is taken. Another powerful tool is quantitative easing, where central banks purchase government bonds or other assets to inject liquidity into the system. This expands balance sheets dramatically and increases the money supply without printing physical cash. The goal is stability and growth during downturns, but prolonged interventions can inflate asset prices and widen wealth gaps between those who own financial assets and those who do not. Critics argue that this dynamic contributes to inequality, while supporters claim it prevents deeper recessions. Either way, the scale of intervention over the past decades has reshaped how modern economies function. And central banks also act as lenders of last resort during crises. When financial institutions face collapse, central banks can provide emergency liquidity to prevent systemic failure. This role is crucial in maintaining confidence, yet it reinforces the idea that the financial system depends on centralized stabilization mechanisms. Markets operate freely until they do not, and at that point, intervention becomes the stabilizing force. This safety net encourages risk-taking in some areas because participants assume support will arrive if instability spreads too far. Understanding the central banking power structure reveals that the economy is not purely organic or self-regulating. It is guided, adjusted, and sometimes rescued by institutions with the authority to expand or contract liquidity on demand. Their policies influence inflation, employment, currency strength, and asset valuations simultaneously. The global economy functions within this framework, and whether viewed as necessary guardians or concentrated centers of power, central banks sit at the core of modern financial reality. Fiat currency and the end of the gold standard. Fiat currency derives value from government declaration rather than physical backing. Before 1971, the United States dollar was linked to gold under the Bretton Woods system, and other currencies were pegged to the dollar. This created a structured international monetary framework where gold acted as a limiting anchor. When that link was severed, currencies became fully fiat, meaning they float based on policy decisions, supply, demand, and global confidence. This shift removed a hard constraint on money creation and introduced a new era of financial flexibility. Under a gold-backed system, expanding the money supply required increasing gold reserves or adjusting convertibility rules. Fiat systems removed that limitation, allowing central banks to expand liquidity more freely in response to economic conditions. This flexibility has advantages. Governments can respond aggressively to recessions, financial crises, or unexpected shocks. However, it also means there is no physical restraint preventing excessive expansion. Discipline becomes policy-driven rather than resource-constrained. Floating exchange rates replaced fixed convertibility. Currency values now fluctuate relative to one another based on trade balances, interest rate differentials, geopolitical stability, and investor sentiment. This introduces volatility but also allows economies to adjust more dynamically. A country facing trade imbalances can experience currency depreciation, which may boost exports and rebalance flows. Yet volatility can also create uncertainty for businesses and investors operating internationally. Critics of fiat currency argue that without tangible backing, long-term purchasing power is more vulnerable to erosion. Supporters counter that modern economies are too complex and fast-moving to operate under rigid commodity constraints. They emphasize that economic output, technological innovation, and productivity ultimately support currency value. The debate remains active among economists, investors, and policymakers because it touches the core question of what money should represent. The transition to fiat did not immediately destabilize the global system, but over decades it has coincided with rising debt levels, expanding financial markets, and recurring asset bubbles. Whether this is coincidence or structural outcome remains debated. What is clear is that fiat currency defines the modern era. It enables rapid intervention, flexible policy, and expansive credit creation, all of which shape the global economy today. How the 1971 Nixon shock changed everything. In August 1971, President Richard Nixon announced that the United States would suspend the convertibility of the dollar into gold. This decision, often called the Nixon shock, effectively ended the Bretton Woods system. At the time, it was framed as a temporary measure to protect the dollar from speculative pressure and declining gold reserves. In practice, it marked a permanent shift toward fully fiat currencies worldwide. The global monetary framework transformed almost overnight. Before this decision, foreign governments could exchange dollars for gold at a fixed rate. As global trade expanded and U.S. spending increased, particularly during the Vietnam War and domestic social programs, the number of dollars in circulation exceeded gold reserves. Pressure mounted as countries began demanding gold in exchange for their dollar holdings. Closing the gold window stopped that outflow but removed the final anchor tying currency to a physical asset. After 1971, exchange rates began to float more freely, and financial markets entered a period of significant expansion. The removal of gold constraints allowed greater monetary flexibility, which in turn supported larger credit markets and increased global liquidity. Over time, this contributed to the growth of complex financial instruments, derivatives, and multinational capital flows. The modern financial system, with its vast interconnected networks, traces much of its structure back to this moment. Inflation rose sharply during the 1970s, influenced by oil shocks and monetary expansion. While multiple factors contributed, the absence of gold backing allowed broader adjustments in money supply. Policymakers responded with new tools and strategies, refining central banking practices in subsequent decades. The era that followed saw cycles of high inflation, aggressive tightening, financial liberalization, and technological transformation in markets. The Nixon shock did not destroy the global economy. Instead, it redefined its foundation. Money became anchored to policy credibility rather than metal reserves. Growth became more closely linked to credit expansion. Financial markets deepened and globalized at an unprecedented pace. That single announcement reshaped international finance, setting the stage for the debt-driven, liquidity-managed system that exists today. The stock market is not the economy. When headlines announce that the market is hitting record highs, it creates the impression that the entire economy is thriving. Indexes climb, commentators celebrate, and optimism spreads across financial media. But stock markets represent publicly traded companies, not the full complexity of economic life. Small businesses, informal labor, wage stagnation, and regional disparities often exist outside those green arrows on a screen. While a rising index can coexist with struggling households, rising living costs, and uneven opportunity. The gap between financial markets and everyday economic reality has widened over the past few decades. Stock prices are influenced heavily by liquidity, interest rates, and investor expectations. When central banks lower rates or inject capital into the system, markets often respond positively because borrowing becomes cheaper and future earnings are discounted more favorably. This does not automatically mean productivity or wages have improved proportionally. Corporate profits may increase due to efficiency, automation, or cost-cutting, rather than broad-based economic prosperity. As a result, asset owners can experience significant gains even when median income growth remains modest. Another factor is market concentration. A relatively small number of large technology and multinational corporations now make up a substantial share of major indexes. When these companies perform well, indexes surge even if other sectors lag behind. This creates an illusion of universal strength. Economic health, however, involves employment rates, real wage growth, small business vitality, supply chain stability, and consumer confidence. These indicators do not always move in sync with stock performance. There is also a psychological element. Market rallies can boost consumer and investor sentiment, encouraging spending and investment. But sentiment is not the same as structural resilience. Financial markets can be forward-looking and speculative, pricing in expected future growth that may or may not materialize. Corrections occur when expectations diverge from reality. The volatility seen in markets reflects shifting narratives about growth, policy, and global stability rather than a direct mirror of daily economic conditions. Understanding that the stock market is not the economy changes how headlines are interpreted. Market performance is one signal among many, shaped by liquidity, expectations, and capital flows. It can indicate confidence or risk appetite, but it does not fully capture employment stability, purchasing power, or overall economic well-being. Separating these concepts allows a clearer perspective on how financial markets interact with real-world conditions without confusing one for the other. Digital money, surveillance, and control money is becoming increasingly digital. Cash transactions decline while electronic payments, mobile banking, and online transfers dominate daily commerce. This shift increases efficiency and speed, enabling instant global transactions and integrated financial services. At the same time, digital systems generate data. Every transaction leaves a record, creating detailed financial footprints. Governments and financial institutions can analyze patterns for security, fraud prevention, and policy insight. But the same data can raise concerns about privacy and oversight. Central bank digital currencies are being explored or piloted in several countries. These digital versions of national currencies would operate alongside or replace physical cash, issued directly or indirectly by central banks. Proponents argue that such systems could improve payment efficiency, reduce transaction costs, and enhance monetary policy transmission. Side critics question how programmable features might influence spending behavior or financial autonomy if restrictions or conditions were embedded into currency design. Private sector digital payment platforms and fintech companies already influence economic behavior through algorithms and platform rules. Access to financial services increasingly depends on digital identity verification and compliance systems. While these mechanisms improve security and inclusion in many cases, they also centralize data within large institutions. The balance between innovation and individual privacy becomes more complex as financial life moves fully online. Digital money also intersects with geopolitical dynamics. Cross-border payment systems, sanctions enforcement, and currency competition are affected by technological infrastructure. Countries investing heavily in digital payment ecosystems aim to increase economic efficiency and global competitiveness. The architecture of digital finance could shape trade relationships and monetary influence in coming decades. Technology is no longer separate from monetary power. It is becoming a core component of it. The movement toward digital money reflects broader technological evolution, not a sudden transformation. Convenience drives adoption, but systemic implications follow. As financial systems digitize, discussions about privacy, autonomy, and institutional authority intensify. The tools that increase efficiency also expand monitoring capabilities. How societies choose to balance these factors will significantly influence the future structure of money and economic participation. What happens when the system breaks? Financial systems appear stable until they are not. Stability depends on confidence, liquidity, and interconnected trust among institutions, governments, and individuals. When confidence falters, reactions can be rapid. Bank runs, market crashes, and currency crises throughout history demonstrate how quickly stability can erode once doubt spreads. Modern safeguards such as deposit insurance, central bank intervention, and regulatory frameworks are designed to prevent such breakdowns, but no system is immune to stress. When systemic stress emerges, liquidity becomes critical. Institutions may hold valuable long-term assets but face short-term cash shortages. If credit markets freeze, even solvent organizations can struggle. Central banks typically respond by injecting liquidity, lowering rates, or purchasing assets to calm markets. These measures aim to restore confidence and keep financial plumbing functioning. The speed of intervention often determines whether disruption remains contained or escalates. In extreme scenarios, currency devaluation or sovereign debt crises can occur. Governments facing unsustainable debt burdens may restructure obligations, impose capital controls, or seek international assistance. These situations can disrupt trade, savings, and investment flows. However, large diversified economies with strong institutions tend to adapt through policy adjustments rather than collapse. Historical precedent shows that financial systems evolve after crises, often emerging with new regulations and revised structures. Economic breakdown does not necessarily mean societal breakdown, but it can reshape priorities and policies significantly. Periods of instability frequently accelerate reforms that were previously debated but not implemented. Financial crises have historically led to new regulatory frameworks, institutional mandates, and monetary strategies. Stress tests the resilience of economic architecture and exposes underlying vulnerabilities that may remain hidden during expansion. Considering what happens when the system breaks is not about predicting inevitable collapse. It is about recognizing fragility within complexity. Modern economies are deeply interconnected and heavily dependent on confidence and liquidity. Safeguards exist, but they require constant management and adaptation. Understanding these dynamics encourages informed engagement rather than blind assumption of permanence. Our systems endure when they evolve, and evolution often follows periods of strain. If you found this breakdown eye-opening, hit that like button and share it so more people understand how the economy really works. Don't forget to subscribe for more deep dives into the systems shaping our world. Stay curious, question everything, and keep learning.